Hello, and welcome to Taxes in 10, where we take a tax topic and break it down in about 10 minutes. My name is Mark Barnes, and I'm the managing partner of Copper Canyon Tax and Accounting Services in Tucson, Arizona. We are a boutique firm specializing in small business accounting and taxes. This episode is on balance sheets for tax purposes. A balance sheet allows you to lay out your assets, liabilities, and owner equity in one document. This document provides you with a snapshot of your company's finances as of the report date. Most of the time, a balance sheet is prepared and presented at the end of a period, which could be month end, quarter end, or year end. When a new client comes in, my first step is to review their balance sheet. Do the numbers look reasonable? Is there enough cash to cover current liabilities? And are there a bunch of negative numbers? Before you can prepare a balance sheet, you need to understand what goes on it. There are three main sections of a balance sheet: assets, liabilities, and equity, in that order. From there, each section is broken down into different types of assets and liabilities. The first type of assets listed are referred to as current assets. Current assets are cash and cash equivalents, as well as assets that can be converted to cash in less than 1 year. This will include your checking and savings accounts, employee advances, inventory, accounts receivable, marketable securities, and prepaid insurance. The next section will be your long-term assets. This section will include property and equipment, such as autos, trucks, and trailers, machinery, equipment, furniture, buildings, and land. It also includes other assets you intend to hold for more than 1 year, such as investments, franchise rights, copyrights, goodwill, patents, and trademarks. All entries on the asset list should be shown as a positive number, with the exception of accumulated depreciation and accumulated amortization, possibly allowances for bad debt against accounts receivable also. If you look and see a bunch of negative numbers, there's a good chance that it's all wrong. In addition, your profit and loss is probably also wrong. I reviewed a set of books a few years ago, and there was a sales tax liability of almost $40,000. I asked about monthly sales and did some quick math in my head and figured their monthly liability was $700 to $800. They had been accruing the tax on the balance sheet, but recording the payment as an expense on the books. They had been underreporting their income by $9,000 to $10,000 per year for several years. Next, let's look at the liability section. The first type of liabilities listed are referred to as current liabilities. Current liabilities are debt you owe that will be satisfied in less than 1 year. Examples include credit card debt, payroll liabilities, sales tax payable, retirement plan payable, customer deposits, accounts payable, loan from shareholder, current portion of long-term debt, and income tax payable. The next section will be your long-term liabilities. These are debt obligations that will not be paid off within 1 year. Long-term liabilities include equipment and building loans, capital leases, deferred compensation, and deferred revenues. Someone just asked me about how to treat Section 1033 insurance proceeds. That's an example of deferred revenue. The final section of the balance sheet is the equity section. Equity is the difference between total assets and total liabilities. Or put another way, equity is what's left after you subtract your liabilities from your assets. In a corporation, you will see capital or common stock, additional paid-in capital, treasury stock, retained earnings, and dividends, distributions, or return of capital, depending on how it's titled. In an S corporation, all three mean the same thing, unless you were previously a C corporation and are taking dividends, and we aren't going to talk about that today. In a partnership, you will see member or partner equity, member or partner distributions or draws, and member or partner retained equity. There are multiple ways to handle this, but we list everything specific to each partner. Is there some magic formula for balance sheets? Why, yes, there is. Assets equals liabilities plus equity. I mentioned a minute ago that equity is what's left after you subtract liabilities from assets, and I know there's an accounting professor out there who got a nervous twitch when I said that. Accounting 101, assets equal liabilities plus equity. This video was written specific to tax return preparation, so I want to cover how we generate the balance sheet information if our client doesn't keep a full set of reconciled books, and also why it is so important to compile the information regardless if it's required or submitted to the IRS. First, let's look at two balance sheets, one good one and one not so good one. You can see in the assets section that we have cash on hand, a receivable, and some fully depreciated assets. Total assets, $406,650. You can see in the liabilities section, they do have some credit card debt, but not significant. There's an outstanding PPP loan, but it is less than 25% of the cash on hand. And there are a few payroll liabilities. This company can continue operations without the fear of running out of cash. You can see in the equity section that they have common stock issued, retained earnings of $226,423, and return of capital of $30,000. And yes, return of capital will be a negative number since you are extracting capital from the company. All of this is balanced out with our current year net income. Total assets, $406,650, and total liabilities and equity, $406,650. Now, for a not so good looking balance sheet. Cash on hand plus other current assets is $144,305. In addition, there's $19,911 of book value for fixed assets, bringing the total assets to $164,216. You can see in the liabilities section that we have some credit card debt. Not bad. But then we get to current portion of long-term debt. If you aren't familiar with this term, we'll discuss it in a minute. We have a loan from shareholder on the books, a PPP loan, and sales tax payable. The next section is long-term liabilities. Several equipment loans on the books totaling $204,119. Now back to the current portion of long-term debt. To calculate, you look at the next 12 months of payments and add up the principal portion. In this case, our long-term debt is $204,119, and of that, $118,135 is due in the next 12 months. This adjustment, for tax purposes, is done once a year. Payments are posted as usual, with the principal portion posting to the liability account and the interest posted to an expense account. You can see in the equity section that we have $1,000 in common stock. Retained earnings is negative $251,103, and net income for the period is $107,241. From a review perspective, you would think this company is doing great. They have net income of over $100,000, but their net income is less than their current portion of long-term debt and less than their current liabilities, even when we exclude the PPP loan. That means the company will have to rely on current assets to continue operations beyond the next 12 months. Is this company growing or maintaining, or are they contracting? Those questions become important when you are trying to help your client in a CFO role. One thing you will notice that is missing is return of capital. There isn't enough cash flow to provide for a return of capital, so this S election isn't providing one of those intended benefits. Okay, how do we create a balance sheet when a client barely tracks revenue and expenses? We use what's called a trial balance. A trial balance, or an adjusted trial balance, is a statement of all debits and credits in a double entry account and book. Any disagreement is caused by an error, an out of balance situation. Creating a trial balance is fundamental in creating an accurate tax return for a corporation or partnership. Let's walk through two examples. A simple one to get us started, then a deeper look so you can see what types of problems are lurking beneath the surface. Example 1. George, and that's not his real name, brings in his paperwork to have his taxes prepared. George is a C corporation and keeps his revenue and expenses on 13-column ledger paper. George has been trained and knows to bring in his December bank statement and loan statements. George has revenue of $67,267 and expenses of $45,397. In addition to this, you have $14,993 of depreciation expense. For simplicity, I'm going to lump all the expenses onto one line so you can see it. Here's our trial balance. Many software programs will have a built-in trial balance, or you can find a sample in the comments below. First, we'll enter our income and expenses, including depreciation. You can see it populate the M1 income at the bottom. Why M1 income? Because you may have non-deductible items listed, like half of meals, entertainment, or non-deductible insurance. Those non-deductible expenses will change the net income per tax on page 1, but not net income per books, and you will reconcile that on Schedule M1. If you are unfamiliar with Schedule M1, I have great news for you. We have a Taxes in 10 video on that, and the link is right here. Okay, let's focus on the top section, starting with assets. They provided a December bank statement, and it has an ending balance of $22,939. And there are no deposits in transit or outstanding checks. We know that they have $372,540 in depreciable assets and $177,626 in accumulated depreciation. We also know that there's $57,352 in land. Now on to liabilities. George has customer deposits of $6,340. He brought in his December loan statement and has an outstanding loan balance of $162,596. In his equity section, we know that he has $5,000 in common stock. This is my client, so I know that the retained earnings is $95,601. Once all this is entered, you will have your M1 income, and it should balance. As you can see on the bottom, we are out of balance by $1,209. After I spoke with the client, it turns out there is $1,209 in escrow, and after we enter that into our trial balance, it balances and we're ready to move forward. Keep in mind, this one is simple, but in the world of accounting, your debits and credits must match. When you pay your electric bill, you debit your electric expense and you credit your checking account. Those two entries match dollar-wise and create balance with matching debit and credit entries. Let's look at one that's a little more problematic. Sally, and that's not her real name, runs an S corporation but doesn't keep formal books. Sally thinks that she has been profitable and has spent the last few years expanding and took on some debt. She wasn't happy with the service she was receiving, so she walks into your office. You inform Sally that you will need far more information to assemble her tax return and send her home with a list. A week later, Sally is back in your office with all the requested documents. Now you can start putting together a trial balance. Sally's tax return is missing a Schedule L, but she has a basis statement that shows $94,275 of basis. Like me, you should be skeptical. Step 1. Enter Sally's revenue and expenses. This gives her net income per books of $28,340. Notice on the bottom, we are not in balance. Trial balance must balance in order to produce a meaningful balance sheet. Let's enter Sally's checking information, and we can see that she bought a truck and fully depreciated it, so we enter the corresponding accumulated depreciation. Still out of balance. Sally has some outstanding credit cards, some outstanding payroll liabilities, and a line of credit for that truck. Still out of balance. You ask Sally about her capital contribution. When she started the company, she deposited $100 of personal money to get started. So you record that as her stock. And you find out that Sally took distributions of $48,000 during the year. Still out of balance. All the accountants just cringed, since the debit column, or the column on the left, is less than the column on the right. This means Sally has negative equity in her company. To get this to balance, we need to enter negative $44,725 for her retained earnings. Remember that basis statement that said she had $94,275 in basis? Now that's impossible. We're going to dig into the main reason why recording a balance sheet is so important to the tax return. In year 1, Sally contributed $100 to start the company, giving her stock basis of $100. During the year, she had $21,000 in net income and took $20,000 in distributions. That left $1,000 of equity in the company at year end. Add that to her $100 stock basis, and her new basis is $1,100. Since she left $1,000 in the company, that becomes her retained earnings in year 2. Her basis statement fails to recognize her distributions, so it says she has $21,100 in basis. Year 2, Sally has $34,000 in net income and $34,000 in distributions. This means she left the same $1,000 in the company from year 1. No change to her basis or the company's retained earnings. But her basis statement once again fails to recognize her distributions and says her new basis is $55,100. Year 3, Sally purchases a $60,000 truck and takes Section 179 depreciation. That causes a loss and everything just went off the rails. According to her basis, she was able to deduct the loss of $25,000 on her personal return. In addition to that loss, she took $20,000 in distributions. Reality, Sally's basis went to zero. Her retained earnings went to negative $44,000, and she has a suspended Section 179 loss of $43,900. So, what happens is we need to look at page 1 of the 1120S. Sally has ordinary income of $35,000 because this 179 deduction is a separately stated item that is taken on the personal return, not the business return. So Sally has basis of $1,100 to begin with, plus $35,000 of net income, minus $20,000 for distributions, totaling $16,100. This allows $16,100 of the Section 179 deduction to pass through and leaves $43,900 suspended to the future. In year 4, Sally has net income of $45,000 and distributions of $40,000. This leaves a $5,000 increase to basis and retained earnings, and it also allows $5,000 additional dollars of the suspended Section 179 loss to pass through, but that reduces her basis to zero. According to her old basis statement, she has $75,100 at this point, not the zero that it really is. Now we're looking at last year. Sally has net income of $19,175 and takes distributions of $24,900. Remember that debt she is accumulating? That is where the money for the distributions comes from. Sally has distributions in excess of basis of $5,725. Her retained earnings is now negative $44,725, and she still has suspended Section 179 deductions of $37,800. Now we're on to the current year. Sally has net income of $28,340, but she took distributions of $48,000. She has distributions in excess of basis of $19,660. Her retained earnings will go to negative $64,385, and her Section 179 deduction of $37,800 will remain suspended. Remember, her basis statement never showed the distributions. Distributions will never be disclosed if you don't dig deeper. And remember, the IRS has a new rule. Basis statements must be attached to the tax return if there are losses or distributions. Only accepting the revenue and expense information guarantees that the tax return is not complete, but also makes it impossible to accurately report the assets, liabilities, equity, and basis. Sally needed accuracy in year 3, and now you are trying to fix it in year 6. Good luck. Make sure to hit the subscribe button to keep up to date on all of our Taxes in 10 video series, and give us a like on Facebook at facebook.com/potentialcpe and on Instagram at instagram.com/potentialcpe. If you are interested in earning continuing education on this topic, please visit potentialcpe.com for a list of all the courses we provide. Our 1, 2, and 4 hour on demand webinars will focus approximately 75% of each hour educating theory and regulation, and 25% of each hour on procedure with real life examples while we walk you through completing the necessary forms to increase your potential.